Louis. I'm Chief Investment Officer at CI Global Asset Management. My background is risk management and asset allocation and portfolio construction. Private markets, broadly speaking, are, anything that's not listed on exchange, right? So that's obviously a pretty broad space. And in terms of accessible for investment, there's a bigger and bigger pool of these assets. There's less and less listed companies, less IPOs, more M&A activity. So obviously, when you think about building portfolios, you want diversification. So that opens up a whole spectrum of new investments. And even when they look similar, I would say the businesses can be run differently. There are pressures coming from being a listed company, the pressure of quarterly earnings and all that you don't have in private space. So that's another dimension of diversification. So I think in sophisticated, well-diversified portfolio now, private markets can play a very important role. The speed at which these markets evolve is slower. That's partly part of their appeal. They're less volatile. They're less reactive to news, if you want. But when we think about, the 5 buckets in private space, we think about private equity, private credit, real estate, infrastructure, and venture capital. The mix will change over time. Obviously, you have some portions of it which are, I would say, more equity-like. VC is obviously, I would say, high beta equity, growth equity. Private equity in general is high octane equity also in terms of equivalent risk, right? If you think about, you take a listed company, a leverage buyout, you take a listed company, you add some leverage. It's difficult to say it's a less risky. The risk has transformed, but it's a high octane equity. When you think about real estate, it's trickier because it can span the whole space. You can buy a hole in the ground in Rio de Janeiro, or you can lease, to a government that for 30 years. So that's a more difficult asset class to grasp. Infrastructure tends to be a bit more yieldy. And credit, although it's credit, it tends to be, I would say, on the higher risk or lower quality grade than what you see, for example, in listed investment grade credit. I think the volatility aspect is non-negligible, right? So if it's sized correctly in a portfolio, it can dampen and smoothen the experience. So if you are measured on the performance of your aggregate portfolio on a risk-adjusted basis, overall, it will increase Sharpe ratio. I don't think that's a reduction in risk, right? And that we get into the questions of what is risk. And we can spend hours discussing that, right? So, but I think what is transformed is typically you get less volatility and you exchange that for, in some cases, complexity risk. So these deals, these investments tend to be a bit more complicated, more or less straightforward, and also obviously liquidity risk, right? And that's probably the most important dimension once you get into private space, and probably the biggest driver of when you try to identify the quantum of the allocation you want to deploy in that space. If you are used to do fund selection or ETF selection in listed space, right? The beta thing exists in listed space, right? And the dispersion between top tier and lower tier manager is in some cases not that wide, right? So your most important decision is to allocate. I'll make a bold statement. I'm not sure everyone would agree to it, but I don't think if you cannot, and if you don't have high confidence that you can allocate to top tier managers in private space, I don't think you probably should get involved in that space, right? So the dispersion is such. And the universe is also more opaque up to a certain, you don't get day-to-day returns, you get less visibility. And because of the liquidity risk, when you allocate for a long time. So all of this together, means that it's very, very important to get enough capabilities and enough expertise to be able to do very thorough due diligence, right? The random private asset manager is probably not very interesting. The top tier asset manager are extremely interesting, and they've delivered returns on a persistent basis. And that's what we want to get access to, right? The universe we look at, which obviously already truncates what is called private funds out there, right? Roughly has 11,000 funds. We end up allocating to, let's say, 12 to 15, three funds by bucket, more or less. We talked about 5 buckets. So obviously there's a lot of screening going on there, right? If you think about dispersion in fund managers in equities, for example, listed equities, roughly speaking, depending on the region, depending on the year, about 200 basis points, 250 basis points between like where the line is between the first and second quartile and the line between the third and fourth. When you go into private space, you're talking about thousands of basis points. So 10% plus dispersion, right? And the dispersion I've insisted on, I talked about also the persistence, right? So dispersion and persistence is powerful, because if you can identify those big managers that have done very well, or they're big now because they've been successful over the years, right? And if you can get access, that's really where you unlock the value of private assets. So again, it's not so much a beta thing. So I would be very careful about saying I want to allocate to private assets. The answer needs to be longer than that. I want to allocate to top tier private managers. Then the question is, can I get access to them? Unfortunately, I think there is too much of an illusion of liquidity in some cases, as you said, right? I would say people say, well, there's secondary market. I mean, if you've ever got involved, I mean, you want to get involved in secondaries buying funds. You don't want to be involved selling it. I mean, the slippage cost is typically much higher. There is a high correlation. People all want to sell at the same time for the same reasons. So I would be very careful there. When it comes to evergreen, then I would say they're not created all equal, right? So on our side, I mean, that's been our main focus, I would say. We outsource, we don't do direct deals. We outsource to external managers. But when it comes to portfolio construction and risk management, I mean, that's really where I think our expertise is internally and where we've built. And that's the reason why the multi-strategy also has 5 buckets is you cannot offer liquidity of a sizable amount if you only have VC, or if you only have private equity, or if you have infrastructure. But once you start to get private credit into it, and once you start having a slight sleeve of listed assets, you can actually provide limited liquidity. And it needs to be understood by everyone. We have a fiduciary duty to people that come in and fund. We have a fiduciary duty to people who want to get out in the liquidity constraints we provide. But we also have a fiduciary duty to people that stay in the fund, investors that stay in the fund. So triangulating all of that, limited liquidity, but it's very important to ask questions about how it's built and how it's calibrated.